Good afternoon to everybody, dear colleagues. Welcome at our traditional open research seminar. And today we are very happy to host the presentation of Professor David Westin from Riksbank. And David spent many years in central banks. He started his career at the European Central Bank almost 20 years ago, and moved after that to the Riksbank, where he spent many years in monetary policy department, leading the work related to the development of macroeconomic models for policy purposes, and after that also working as the deputy director of monetary policy department. But last few years, David works as a researcher in the research division of the Swedish central banks, and his topics of interest include macroeconomics, include term structure and balance sheet of the central banks. But the topic which will be covered today is very important for our case as well. That is the topic about the monetary policy communications. And probably you know the situation we at the Central Bank of Ukraine faced the last few months. So we started to hike our interest rates, and actually that was the surprise for the market agents, for economic agents, and nobody. Majority of the financial analysts were not able to predict these moves. And today we will consider the research which is devoted to something similar, but in the Swedish case, when the forecast of the central bank and the forecast of the professional financial analysts differ. And okay, let's see what research on this topic at the Riksbank can produce for our case, for some maybe meaningful conclusions for the monetary policy in Ukraine as well. Okay, David, the floor is yours, please.
Thank you, Sergei. All right, so this is very preliminary work. It's work with my former colleague at the ECB, Oreste Tristani. And the usual disclaimer really applies this time. It's something you always put up there. Most of the time, nobody could care less. But this time, we're actually going to talk about some contentious stuff. So this time, I really want to point out that disclaimer. It's really our own views and so on. It's very preliminary work, so feel free to interrupt at any time for clarifying questions and so on. And you're going to see that we're essentially in the middle of this research project. So I'm going to show you the motivation, some preliminary results, and some discussion, and also some policy sort of conclusions towards the end. But don't expect to see a final paper, because it's really work in progress. Okay, so the motivation here is that expectations have always played an important role in conducting monetary policy, when thinking about monetary policy. And if you go back to the 70s to 90s, roughly, to the early 90s, you had, on the academic side, you have Bob Lucas' work essentially saying that it's only unexpected inflation that matters. So you had a Phillips curve of the type very similar to the ones we look at on the next slide, but where expectations were backdated. So it was only the surprise inflation that generated an effect on real activity. And when you looked at communication at central banks, Greenspan had some famous quotes essentially on the lines of saying, if you have understood what I said, you probably didn't listen well enough, or something like that. The point was he didn't try to be understood by financial markets. And even to the extent that when the Board of Governors made decisions, or when the Federal Open Market Committee made decisions on the federal funds rates target, they didn't even communicate those decisions. They just told the trading desk of the New York Fed to implement it, and then markets learned through the actions of the operations desk what the new target must be. So that was the level of transparency back in those days. And in contrast, Woodford on the academic side has made a sort of was a sort of formulating a completely new theory of this, or relatively new theory, in the New Keynesian Synthesis, where there was a lot of emphasis on expectations. It's not only current policy that matters, it's also expected future policy. And if you look at the sort of workhorse model of the new Keynesian economics, you can find that in the first couple of equations. So the first is a forward-looking Phillips curve, where inflation is determined by expected future inflation and the current level of output gaps. This equation comes from the pricing decision of firms, where prices are assumed to be rigid, so that with some probability, when you change your price today, you will expect that price also to last for future periods. And this is obviously the key ingredients that differs this analysis from the Lucas-style assumption, where all prices were flexible. And what's going to happen in this economy is that forward-looking price setters, the output gap is a proxy for marginal cost, essentially. And there are reasons why marginal cost is higher when output is higher. The first is that marginal utility of consumption will be lower, and the marginal disutility of work will be higher. Both of those things leads to a higher real wage required when output is high, and hence marginal cost of production is increasing, even if you have constant returns to scale in production. Now that's exacerbated if you have decreasing returns. So if high output is associated with low product of labor, that's a reinforcing channel that makes marginal cost respond even more to variations in output. And hence the output gap sort of proxies marginal cost. What the Phillips curve tells you is because some prices are rigid, also future marginal costs matter. And if you sort of take that equation, you push it forward, you can have this representation which tells you that the current level of inflation in this framework essentially depends on the expected value of all future output gaps discounted, and the output gap again proxies marginal cost. So it just tells you that when you set your price today, you're not only going to think of normal cost conditions today, marginal cost conditions, you're also going to care about all the future expected marginal cost conditions. Similarly, in the output gap equation, where this is really the Euler equation for the representative household for intertemporal savings decisions, where this sort of stands for essentially marginal utility of consumption today, this is expected marginal utility of consumption tomorrow, and this is the real interest rate. Now, these are gaps from the natural equilibrium, and that's why you have the deviation from the natural rate of interest, which is the real interest rate level that will prevail in the flexible price economy. So very quickly, these are the sort of two building blocks of the new Keynesian model. If you take this equation, push it forward, you get this equivalent representation, which tells you that the current output gap is driven by all future expected real interest rate differences from this natural rate counterpart. If you have flexible prices, this collapses to just one equation, telling you that it's only the current deviation from the natural real interest rate that matters, and that deviation will, by construction, be zero if all prices are flexible. Now, this is the real interest rate that actually happens in the economy. Clearly, if some prices are rigid, then monetary policy will have an influence on the real interest rate of the economy. Remember, if all prices are flexible, if the central bank raises interest rates, that can be totally offset by all prices adjusting, keeping the real interest rate unchanged. But with the assumption that some prices are rigid, this interest rate will respond to movements of the nominal interest rate induced by the central bank activity. And hence, clearly, you see from these sort of very stylized equations that it's the entire future path of nominal interest rates in this economy that will matter, not just the current one, and hence the focus on expectations in the new Keynesian model. So focus very much shifted from the unanticipated inflationary things to instead be very focused on the explicit expectations about future interest rates. And all the literature on communication is sort of arguing that we should publish interest rate paths, talk about the future, talk about how we conduct monetary policy, can sort of intuitively be captured through this type of logic. That it's expectations about future interest rates that matter, and the current interest rate only has a limited effect on the economy. So if you take this over to how inflation targeting central banks are behaving, they typically emphasize forecasts, and essentially they're trying to get inflation back to target before too long. where too long is a bit loosely defined. It could be 2 years, it could be 3 years, it could be the medium term in the case of the ECB, but they all have some notion that we want inflation to sort of gradually go back to target. They typically use a consistent approach in the sense of using some economic model, economic theory, that does rest on the assumption of what they will do. Because of these equations, they have to make an assumption about what monetary policy is going to do in the future. Otherwise, you can't tell what inflation currently will do unless you have a completely backward-looking model. Now, they may or may not publish explicitly that assumption, but they certainly have some assumption about what monetary policy is doing. The problem is that these models rest on perfect information. So, in a way, if you have a sort of off-the-shelf DSG model used by most central banks, you implicitly assume that all agents have exactly the same information in the economy, all agents have exactly the same outlook for the economy, they believe in the same structural shocks and in the same forecasts for the economy. Clearly, according to this equation, it's the private sector expectation of future output gaps that matter. Why? Because it's the individuals making decisions, they trade off their own marginal utility of consumption against their own expected marginal utility of consumption. Clearly, they don't care what the central bank is expecting, they care about what they expect themselves. And hence, if there's a difference between what the central bank expects and what they expect, it's what they expect that will actually drive and have an implication on the real economy. In contrast, the central bank, when conducting policy, obviously care about its own expectation. And if you have expectations of the central bank in the policy rule, that we will look at later on, then, of course, from the viewpoint of conducting monetary policy, those expectations are what matters. And hence you see that if the expectations differ, both of these expectations will play a role in this economy. And to make things worse, both expectations and on top, other expectations of higher order will matter. So when the private sector thinks about future interest rates, it will not only think about its own view of the economy, given that it's the central bank that sets interest rates, it would also have to form a view of what the central bank thinks about the economy when setting future interest rates. And hence, private sector expectations of central bank expectations starts to matter. And the other way around, when the central bank tries to interpret information in the economy by looking at outcomes like consumption and inflation, they have to form an expectation of what they think the private sector is expecting, because that's part of what's driving current inflation. And then you end up in this sort of infinite regress where higher and higher order expectation starts to matter. And fortunately, from a practical perspective, it turns out that the importance of those terms diminishes very steeply, and it's essentially only the first and second order terms that sort of shows up significantly when you have to solve these models. Okay, and the point is, what does this mean? How do we interpret these deviations? What's the implication for the forecast, and what's the conduct for optimal? What's the implication for the conduct of optimal monetary policy? And just to give you a sense of the kind of discussion that we've had at the Riksbank was, suppose you have some forecast of the economy, suppose you think interest rates are going up, but suppose now market thinks that they're not. The market thinks that interest rates are going to be flat for the next couple of years. What do you make of that difference? One interpretation would be to say, I believe that once I publish my interest rate path, immediately market rates would jump up and follow spot on to my own prediction. If that's the case, surely my forecast would be consistent. Not necessarily. And the reason is that if the private sector expects market rates to be very low for a long period of time, they would have formed economic decisions like trading off current consumption versus future consumption based on that particular forecast of very low interest rates. If you all of a sudden make agents believe that interest rates are going to be 2 percentage points higher for the next 3 years, that's going to be a big shock to them. That shock has no place in your standard representative agent model, because there, by construction, all these forecasts are the same. But in reality, it may well be a big shock to markets if you announce something that they did not expect. As Sergei mentioned also now initially here in the beginning, that if markets here were sort of a bit unprepared for the fact that interest rates were going up, that may lead to some sort of behavioral adjustments once they realize that this is going to happen. And so a reality check then is markets do not agree. So sometimes we observe large differences between the central bank's own projection and from market-based interest rates. Now, admittedly, a part of that discrepancy may be due to time-varying risk premia and other factors and so on. You could sort of discuss how much of that you should discount, but at any rate, it seems plausible that given the size of discrepancies we've been observing in the data for the past few years, it's relatively safe to say that it can certainly not only be explained by time-varying risk premia in the forward curves. Okay, and the point then is that markets look at the central bank to try to get information about what the central bank is thinking. The central bank looks at markets, but how is this discrepancy actually sort of resolved? And the research questions that we aim to explore in this paper is, one, try to build a model that can account for these kind of discrepancies. So how can we even get the model where that kind of discrepancy is possible? And secondly, what do they impose for or imply for the stance of monetary policy? And that means how expansionary is current monetary policy? And the third question is, what does it imply for the optimal conduct of monetary policy? And we're essentially somewhere between Q1 and Q2 right now, and you'll see three versions of the model, or three different assumptions that we've played with that can generate some of the things that we want, and we have not had time to actually discuss the optimal conduct of monetary policy. So as an example, consider the case in July 2009. We had just experienced the severe financial crisis where the Riksbank lowered interest rates by over 4 percentage points down to the trough here. At this time, markets thought that interest rates were going to rise according to the following curve. And that's after the announcement of the policy decision taken here, sometime in the middle of 2009 in July. Now, this was the actual path taken by the interest rate, and this was the path projected by the central bank at the time. So we were essentially correct, but then incorrect for the longer term. We foresaw that rates were going up, but we didn't see that they would be going down again, clearly. Now, a completely different picture in 2013. Here instead, the Riksbank thought that the interest rate should be gradually raised, and the markets thought that it would not be. And in this time, markets turned out to be right. In reality, our repo rate fell even into negative territory, so we were actually both wrong, but the central bank was more wrong than the markets. And this is to illustrate that these discrepancies can be both up and down. They can unfortunately be increasing over time. So you see there's a small discrepancy for the initial period, but then there's a widening gap in views of the central bank vis-a-vis markets. Similar picture arises if you look at other data from banks that do publish interest rate paths. You can look at the US. There is not as clear because they don't publish an official forecast for the interest rate, but if you look at the dot plots for the individual board members, you can certainly see from time to time that the sort of median or average dot in those charts would be substantially different from the implied market-based forward rates. And then the question is, how do we actually model, how do we account for this? To take an extreme example, look at September 2011. Here the Riksbank, after gradually raising interest rates pretty dramatically, foresaw that interest rates would continue to increase quite a bit. And we actually lowered, though, our forecast. There was worse news in the euro area coming out and so on, so we lowered the forecast. Markets, in contrast, already believed in very low rates, and they, if anything, adjusted their own forecast a little bit upwards in the face of our own communication. So here's an example which is kind of embarrassing for the central bank, where we were completely wrong. The markets were very, right, exposed, and where the adjustments went opposite ways. So here, clearly, we did not manage to guide expectations that well, but on the other hand, expectations turned out to be much better than our own forecast. So this is a case where you see widening discrepancies, and one possible interpretation for this was that the markets and the central bank had a different perception of the natural rate of interest. You know, what is the real interest rate needed to have an accommodative or a neutral monetary policy stance? One interpretation was that the Riksbank thought that that rate was substantially higher than the markets, and then gradually we adjusted our views, and today perhaps we share the fact that we believe that that neutral interest rate is much lower than we thought at this time. Something I'll come back to later on. Okay, so the takeaway here is that we often see relatively large differences, and we sometimes observe reasonable agreement about the short run, but widening differences further out. So we need a model that can sort of account for this, and we clearly understand that we have to go outside the representative agent framework with rational expectations and everything equal. We want to deviate as little as possible, so we're going to maintain the assumption of rational expectations. Clearly it's tempting to say, suppose you have some irrational part of the market that reacts differently and so on. We actually explicitly want to entertain this environment where both the central bank and the private sector is sophisticated, rational, doing the best they can. It's just that information is imperfect, so ex ante you don't know who's going to be right. Sometimes it will be the central bank, sometimes it will be financial markets. As you saw from the two examples in the case of the Riksbank I started with, there was a case where the central bank was right, there was another case when markets were right. And what we're going to do here is to start out with the simple observation that this perfect information framework essentially rests on one assumption, which is full observational. It's fully possible to observe the shocks that are hitting the economy. So if you take a standard macro model, you might have a technology shock, you might have some cost push shock, you might have some sort of tax shock or whatever. And we typically assume that all those are perfectly observable, and the only thing the central bank needs to do is to figure out how to respond to those shocks. And the private sector does the same, and then the economy sort of reacts. Now, in reality, if you call up somebody and ask what's the current level of technology, typically nobody can answer that, because the estimate of the current technology shock will be model dependent. It will rest on a number of sort of unrealistic features that are not present in reality. For example, if you know anything about real GDP data, at least in Sweden, and I presume it's the same here, those numbers are substantially revised, even years after initial publication. So if you want to try to guess what current GDP is, you can look at the numbers, but you should expect them to radically change over the years. And hence, if you have a changing perception of the level of output, clearly that will imply typically a changing perception of the current level of technology, because that, technology drives maybe 70% of variations of output according to a standard macro model. And so what we're going to do is to allow dispersed information. So we're going to have some variables that are perfectly observable for all agents, both the central bank as well as the private sector. But there's going to be some dispersed information where the central bank might have a slight difference in the ability to observe the shocks than compared to the private sector. And we'll look at exactly how that looks at, what that looks like. Now, what the agents are going to do is that they are going to use a Kalman filter to try to extract the state of the economy. So typically we use a Kalman filter in the DSG setting for the econometrician to figure out what the economy was doing. But this time we take the Kalman filter into the micro foundations of the model and instead say, look, actually all agents in the economy are like the central bank economists trying to estimate these models. They don't know technology either, or aggregate technology. And they use the Kalman filter type of setting to figure that out. And because they have slightly different information sets, they're going to arrive at slightly different conclusions about the state of the economy. Given the state of the economy, they're going to make forecasts. And obviously, if they have different perceptions about the state of the economy, they're going to make different forecasts for what's going to happen in the future. And more explicitly, and perhaps most obviously, suppose you have two shocks driving the economy, one technology shock, which is very persistent, and a temporary demand shock. If you look at the data and you come to the conclusion that it's technology driving things, your forecast is going to be, this is going to have a persistent effect on output. because if technology is high today, shock is out of the economy, and then your forecast is relatively different compared to the two. So if you manage to arrive at an equilibrium where two agents can look at the same data and draw the conclusion such as this, that one thinks it's technology, the other thinks it is demand, then they're also going to differ in their forecasts. In reality, obviously, it's not going to be a sort of corner solution. They are going to think that it's a mix of both, and depending on the quality of the information, the precision of the signals, one agent will be more right than the other. And of course, we can calibrate the model to examine the case when the central bank knows more than the private sector, but we can also turn it around and say that the private sector knows more than the central bank, and then we can sort of see what happens. The key references here are Lorenzoni has an AAR paper, Angelettos has several papers recently. Kohlhaas is the most important reference for us because we're essentially starting off in his framework, and Chris Niemark has a paper where he sort of shows how to solve these type of models. It's a standard rational expectations model, but the problem is that we have these higher order terms affecting the solution. So not only first order expectations matters, but also higher order. And the question is how to handle those, and his paper is about how to sort of reformulate the system in a way where you can do this. So any questions at this point? Okay, so what we're gonna assume about the model is that we're gonna start off in a type of Lucas Island model, again following these references. So we're gonna assume that there are many small islands, and essentially each island separately features the standard type of New Keynesian model. So you're gonna have production of an island-specific good using island-specific technology. And the reason why we want this is because we want to say that island-specific technology has like an aggregate component which is the same across all islands, and then an idiosyncratic component. And if that idiosyncratic component is large relative to the aggregate component, then observing the island's own technology gives a relatively imprecise signal about the aggregate technology in the economy. And the assumption here is that that is the information of the private sector when it comes to the shock itself. So they can see their own technology clearly needed because it shows up in their production function, but they cannot see aggregate technology, and they have to look at the data and infer what aggregate technology is actually doing. Standardly, we're going to assume this is one way to formulate the New Keynesian model. So we're going to assume that there are many or a continuum of intermediate inputs, and that sticky prices occur at the intermediary goods level. So think of like an assembly process where you take lots of intermediate goods, you pack them together into the island-specific final good, and that you sell both to your own island but as well across the other islands. So you're like exporting that good as well. And the sticky prices arise at the intermediary goods levels, which means that we have sort of monopolistic competition at the intermediary goods level. So if I'm an intermediary producer and I have a high price, the guys doing the assembly are going to choose relatively little of my particular intermediate good. And the lower the price I have, the more people will substitute into my good. And we assume monopolistic competition with a certain constant elasticity of substitution across goods, so all firms will receive some demand for their intermediate goods. Okay, now households on each island owns the firms on the same island, but not across the rest of the economy. And this induces an element of incomplete markets. So there are two elements of incomplete markets, both because of ownership of firms. The second one is that they're assumed to work in the firms on the island, but there's no labor mobility across islands. So people will not migrate and work sort of part-time on other islands with higher wages, let's say. And that induces incomplete markets. So in a way, this model is a little bit in the spirit of the sort of Hank type of models that have become popular recently. Okay. Then the consumption aggregate consists of aggregating all the different goods on the islands. And it's a standard Dixit-Stiglitz aggregator, so everyone wants to consume all the island goods. But if prices are different, they're going to consume more of the cheap goods at that final stage as well. So an island that happens to have a high price will receive relatively low demand from the external economy. We're going to assume that all islands share the same preferences, so the consumer of all islands share the same preferences, which is their own consumption, less the habit parameter, less aggregate consumption in the entire economy from the previous period. So standard, apart from the J notation here, on island J, you care about aggregate consumption, not about your own consumption. And then we have a labor component utility, so you have increasing this utility of labor. The more hours you work, the higher marginal disutility of work you're going to get. This integral allows for the Woodford case that each agent on a particular island works in all the different firms. Clearly unrealistic, but it's done to increase the slope of the Phillips curve because of the strategic complementarity issue that arises. Okay, now to spare you a lot of algebra and instead focus a little bit on the policy discussion towards the end, we're not going to go through the micro foundations of everything here. Just take for granted now that if you set up the microeconomic problem, you solve first order conditions, you linearize, you aggregate, then you get to something very close to this. It's a little bit approximate, but essentially it's going to look like this. And this looks identical to the standard New Keynesian model of Woodford's handbook chapter in the Handbook of Monetary Policy, for example, where you're going to say that if you have some indexation on the part of agents who don't change prices optimally, you're going to get this lagged inflation term showing up in the Phillips curve. You're also going to get the output level or gap, depending on how you formulate it. Here are going to be inefficient shocks, like markup shocks, wage markup shocks. This is the Euler equation. So this is the second equation of that simple model we looked at before, with the difference that now, because marginal utility of consumption depends not only of current consumption, but also on aggregate past consumption, you get sort of additional terms here. So this is essentially marginal utility of consumption today. This is marginal utility of consumption tomorrow. This is the interest rate component, and this is just an exogenous shock component. We're going to work with two versions of the Taylor rule. The first version looks like this, where interest rates are set as a function of lagged interest rates, central bank expected future inflation, central bank expected future output gaps. This future output gaps and future expected inflation, slightly non-standard. We impose it here to allow this sort of feedback between private and central bank expectations, and sort of allow that to have a little bit of an extra role. If we would take no central bank expectations here, we would sort of take away a little bit of that channel. Might call it cheating, but it's there to sort of enhance the mechanism that we want to examine, which is the interaction of private sector and the central bank expectations. We're going to play with another version of the Taylor rule, where we instead put the neutral real interest rate as an intercept in the Taylor rule, and I'll come back to that later on in the presentation. Informational assumptions, so this is the sort of key deviation from the standard framework. We're going to assume that both the private sector and the central bank can observe aggregate variables perfectly. So this is clearly an overstatement, given what I said before. Actual GDP numbers are quite volatile and are revised lots of times. But now we're going to abstract from that. So now we're going to say that aggregate output and aggregate inflation, interest rates, can all be perfectly observed by the private sector as well as the central bank. On top of this, the private sector and the central bank receive these imperfect signals of technology. And in the case of the private sector, it's going to be the actual technology appearing in island I. So remember all of these different islands, now pick one of them. They are going to have a certain realization of technology, which consists of two parts. One is the aggregate technology that are driving the entire economy, The other part is an idiosyncratic component specific to the current island we're talking about. And these shocks are then sort of obviously normally, or not obviously, but they are normally distributed and independent across the islands. The central bank is going to have its own signal, also equal to the sum of aggregate technology and the central bank idiosyncratic sort of informational shock here. And notice that the interpretation here is slightly different. Here, this is the observed technology appearing in island I. This is the noise induced in the central bank's perception of aggregate technology. So here, if you have a very skilled monetary policy staff, let's say, that spends lots of time analyzing data from all parts of the economy, they can reduce this noise to the point where they would get, hopefully, a very good estimate of actual productivity. In reality, we're faced with the fact that numbers are changing, this and that can be proxied as saying, no, the central bank can't get rid of this variance. There's always going to be that noise sort of plaguing the central bank estimate of aggregate variables. And so the key here will be how much, what's the relative variance of these two shocks. If the variance of this shock is substantially smaller than the variance of this, it's going to mean that the central bank has much better information than the private sector. If the reverse is true, it means that the private sector is much better informed about the state of the economy than the central bank. So if you believe technology to be sort of very almost equal across all of the islands, and the central bank having a big problem tracking all of this, then the private sector is going to know much better. If you think that various parts of the economy, let's say, that this sort of tries to approximate, has relatively big discrepancies in terms of these shocks, then it's going to be the reverse, that the private sector would be, each individual in the private sector will be relatively ill-informed, and the central bank will be relatively good informed. Okay, and now later on, and unfortunately we're not going to be able to cover this, but later on the issue will be what happens now if the central bank releases its path for future of its own expectations about future variables. Then certainly this will tend to reduce the noise in the economy, because irrespectively of whether the central bank has a good or a bad forecast, the private sector knowing about that forecast will tend to lower will tend to make the private sector's estimate more precise. If the private sector's estimate is more precise, the central bank will also learn from the private sector using the usual sort of logic here. But we find it difficult enough in order to generate these differences, even in the case when the central bank doesn't say anything about what it believes about the future. So we're really starting off in the old paradigm here. The central bank only communicates by moving interest rates at this stage, and sort of tells private sector implicitly, if I move my interest rate, given what you know about my policy rule, I understand, the private sector understands that I expect inflation to increase, for example. That's why I raise interest rates. But it's not communicating about it. It's just showing the private sector that by raising interest rates, this is the stance of monetary policy. Okay, so the key shock is technology, because it drives so much of the variation of output and so on in these models. So we're going to look a little bit at that. And we're going to introduce one additional element, and the reason for that becomes clear later on. So this is a standard specification of technology. Current technology is equal to, some autoregressive persistence of old technology, plus an innovation. And this is a sort of normal technology shock. We're going to add another shock to this as well, and you see the dating t-1 here. So this is something that was realized at t-1, but that doesn't have implications for technology until period t. So you can think of this as some sort of discovery that people understand in the next period will influence productivity. Or something in the labor market, given this very reduced form type of model. If you believe in labor hoarding, then labor hoarding will show up as a temporary productivity shock, and that may also be part of this, essentially. If you think that the economy is in a slump, but because of search and matching costs, firms are going to stick with currently unproductive workers because the cost of firing them and then having to rehire them in future periods outweigh the benefits, and therefore they're going to stick with sort of too many employees. That's going to drive down observed productivity, and that's going to show up like a negative productivity shock. Now the key point here is that it's observed prior to its arrival in the economy, so keep that in mind. The solution method we're going to use, just check how I'm doing on time. The solution method we're going to use is that we're going to aggregate everything here. We're going to get this infinite state vector, because essentially the current perceptions of the state variables, to make it concrete, the unobservable shocks that are persistent, the perceptions of those variables will be state variables in this economy, which is new relative to the standard case. So in the standard case, only the technology shock itself would be a state variable. Here, on top of that, the current expectation of current technology from the viewpoint of the central bank would be a state variable. The current expectation of the current technology from the private sector will also be a state, and higher order expectations, in infinite regress will be state variables in this economy. And that's the problem, and that's why you have to do something special. What Niemark proposes is to cut off after k rounds. So essentially, don't do the infinite regress where you say, my expectations of your expectations of my expectations. Don't do that forever, but stop after k rounds. And it turns out that in our case, k equal to 8 is sufficient, in the sense that if we increase k even further, there is no change whatsoever in the impulse response functions and so on of the economy. Furthermore, which I find reassuring, is that it's actually only the first, second, and maybe the third round that actually does have a significant effect on the impulse responses. So, meaning, my expectations, if I'm the private sector, my expectations of the future matters, makes sense. My expectations of the central bank expectations also matter. I think that makes sense, but no more. So it's not that I would say, oh, my expectations of the central banks, expectations of the central banks, to 8 periods. That, if that would matter a lot, you would say, is this really reasonable? And we would answer no. But it turns out that doesn't happen in this type of model. So it's only the first few higher order terms that actually significantly influences the economy. Okay, and as I said, both the private sector and the central bank are going to use Kalman filters to extract the state of the economy. But since they have different information sets, they're going to arrive at slightly different conclusions. But the conclusions will be compatible with an equilibrium, meaning they will both look at the same information and arrive at different conclusions about why we see what we see in the data, which I think is perfectly consistent with reality. The central bank looks at the same data as the private sector, and still they manage to disagree about the future course of monetary policy and inflation and output. In terms of equations, we're going to conjecture a solution that Kohlhaas is actually proven that this conjecture is correct and results in a unique equilibrium. We're not going to prove that here, we don't have time. But believe me when I say that you can conjecture this solution. And here you're going to see these are the variables we're interested in: output, inflation, and interest rates on the aggregate. They're going to be functions of lags, clear from the sort of usual, the habit persistence term, indexation term, and the presence of lagged interest rate in the Taylor rule. Those three are state variables, so that's nothing new. This is nothing new. Interest rates drive these variables, and the shocks that happen in the economy clearly will also affect these variables. What is new is this component. And what is that? Well, this vector summarizes, it has lots of different terms. The first bunch of terms are the actual state variables of the economy. So if you, the actual persistent shocks of the economy. So imagine we only have one such shock, which is technology. Then the first element of that vector would be technology itself. The second part would be private sector expectations of the previous part and central bank expectations of the previous part. So the two first order expectations will also be state variables in the economy. Then the next block would be private sector expectations about central bank expectations, and central bank expectations about private sector expectations. And I won't bore you with how complicated this gets, but you know, the gist of it is that this vector will consist of all those terms. And you see infinity here, which is never a good sign when you're trying to solve models, and this counts the number of state variables. And that's why we had the discussion on the previous slide of the Neimark solution, where you replace infinity with k, and then you have something you can handle, you know, numerically at least. And then we also conjecture that these state variables, and you can prove that that's correct, only depends on the lagged perceptions of themselves, plus a response to the innovations in the economy. Now, if you stack these things together, so this first equation is just these two equations stacked. So you move up the interest rate there, and you sort of combine all of this. Then you get the first bunch of equations up here. And you see that essentially you have something on the left-hand side which is perfectly observable. Note the little trick here, that we moved everything here on the left-hand side that was observable, both lagged values of the aggregate variables. We assumed that they were observable perfectly. Interest rates are also perfectly observable. Let's take those over to the left-hand side. Then you see that what we have is something where this is perfectly observable at time t from the viewpoint of agents. However, this is not. So here you have all these state variables that are not perfectly observed. Here you have the non-persistent shocks in the economy. But then you see that this looks very much like a Kalman filter. You have an observed thing on the left-hand side. You have state variables on the right-hand side. You have an assumed transition for the state variables of the following form on the right-hand, consistent with the right-hand side. So this is the observation equation of the Kalman filter. This is the transition equation of the Kalman filter. And hence, agents can use this to sort of figure out optimally, given what they know about this, of the stochastic properties of the economy. And here we assume that they know everything. So they know their own relative precision of the signal, they know the precision of the central bank, all the structural parameters are known. Then they take, apart from this, they take the additional information that they have, which are their private signals. Forget about these two, we didn't discuss them. Think about the case when there's only a technology shock. Then there's this additional thing that on top of this information, they also have their private signal. But their private signal is perfectly mappable into this, because remember that the technology shock was the first element of the xt vector, and these are just sort of IID shocks, so they go in here. And hence, you really have a Kalman filter where you have observable variables plus that private signal, and on the right-hand side, you have the sort of observation equation. And logically, what you have here is that given that you know the relative variances of the shocks, you know the processes for the Kalman for the transition equations, you can essentially figure out what's the most plausible explanation. So this is like if you don't know the Kalman filter, think of a maximum likelihood problem. You know the distribution of the shocks, you know what a certain shock will do to the current variable. Given the observation you have of the current variables, what is the most likely explanation for why the current variables are looking the way they do? So for example, if you know this model, you would say that if you see output going up and inflation going down, that's typically a positive technology shock. But it could also be a combination of demand shocks and other things. And then it depends on the size of the movements and the relative variances. When you put on your Kalman filter glasses, which shock will you put as the most likely explanation? So even if a technology shock perfectly fits, if it fits, not permanently, but if it fits good in the sense that it moves output up and inflation down, it may still be that you're going to need a huge technology shock to explain the movements you see in the data. And then the model is going to say the likelihood of that technology shock occurring is essentially zero, because the distribution doesn't allow very, very large technology shocks. And by the way, I think that's the reason why many DCE models had problems during the financial crisis, because they were estimated on past data that did not see such big deviations of GDP from normal. And that meant sort of that the model was forced to use all the shocks in the economy to explain what might have been considered as a true demand shock. the model still is going to spit out that, no, this must be a combination of all the shocks you have, because it's too costly for me to say, even if the demand shock pattern fits nicely, it's too costly for me to say that this was just a demand shock, because such big demand shocks never happened in the past, essentially. Okay, so results. If you look at what happens when a true technology shock hits, and we calibrate this such that the private sector noise is larger than the central bank noise, you're going to see that comparing the red line, which is the full information case, to the partial information case, you're going to see a bigger reaction of output, a smaller reaction of inflation, and about the same reaction of the interest rate. So you see some moderation and some exacerbation of what actually goes on in the economy. And if you look at interpretations, the blue line here is the true technology shock, which is up here. The yellow line is the central bank perception of technology, and you see that they underestimate the degree of the technology shock that hit. And the private sector underestimates it even more. And this is sort of consistent with the assumption in the calibration that the central bank has less noise than the private sector. And of course, you could overturn this by calibrating the model the other way around, so that the private sector would have a more precise signal. In terms of forecasts, this leads to a difference in forecasts, but you see it's not very impressive. But nevertheless, it goes the sort of right way, in this case, it's the central bank. The blue line is the central bank, the red line is the private sector. And you see that the small difference in their perception about technology leads to a difference in the forecast for output and inflation, and hence also a difference in the forecast for interest rates. Now, the problem is that with these type of models, typically these differences will be maximal in the first period. And the reason is that the uncertainty we allow is for the nowcast. So imagine the technology shock. I view the technology shock slightly in a different way than you do, but the technology shock is AR1, so it's going to go back to steady state, and once it does, our discrepancy is going to sort of unfold. And therefore, we're going to consider two other ways here. One is to consider news shocks, and this is like Schmidt-Grohe introduced for technology a while ago. So essentially, like we discussed in the beginning, that this is a part of the shock that becomes known in advance. So before it actually influences the real economy, people will receive some news that it's coming. So it's like saying, I know technology is going to improve in 4 years. Or not necessarily know, but I get a signal that technology is improving in 4 years, and that leads me to react even today. So that's the logic. And the reason why we do this is that because obviously if you have different perceptions about these news shocks, and the shock is occurring at the later stage, and the impact of the shock is larger at the point when it occurs rather than at the point where it's announced, you can understand that you might get this sort of widening difference in the forecast compared to our previous setting. And if you do this, you're going to get similar charts that we looked at before, but now the differences are much larger, and also you're going to have this sort of tendency to allow some opening up. So if you look at the interest rate difference here, the blue line is the central bank, the red line is the private sector. You're going to see that initially there's a small difference, and then it's widening, and after 4 quarters it reaches sort of its maximum. So still a little bit too short. We want differences, according to the data, we might need differences 2 years out in order to explain the data. But this tells us that it's going the right way. So if we had further news shocks, they're going to allow, with longer leads. So if we say technology news about 4 quarters ahead, we're going to see even larger gaps opening up. The cost of this, though, is that the number of state variables dramatically increase. Because if we want these news shocks to be persistent, they're going to enter in this X vector, and then expectations of expectations and so on is going to start to kick in, and the system tends to blow up a bit. Just to say, there are many possible differences for why these expectations can be different in reality. We allow only one, which is the nowcast. So we are essentially saying There's a nowcasting team at the central bank, there's a nowcasting team in the private sector. They reach different conclusions. That's it. Other possible sources are, of course, different beliefs about the structural economic relationships. I mean, imagine when you put Bernanke in the same monetary policy committee as Kocher-Lakota, you know, an RBC guy versus a new Keynesian, essentially. A completely different view of the world and of transmission and everything. They still have to come up with a decision in that monetary policy committee. And if you can have those differences inside the central bank, clearly, why not think that there could be such differences, you know, inside the central bank versus the rest of the economy? You can also have different beliefs about the objectives of monetary policy. So the private sector might correctly or incorrectly perceive a difference from what the central bank is doing from what it has announced as its official target. So in our case, for example, there was lots of discussion of house prices and other things, and some in the private sector interpreted this as the central bank is now not only doing inflation targeting, it's also trying to restrict credit growth toward the big house price increases we saw in the Swedish economy back in the day when we raised interest rates and then had to reverse course. Now, one further possibility is the time-varying neutral rate. This has an effect already in the previous model because it affects the output gap. Remember, you have the natural rate of output subtracted from the actual output. If you don't know technology, you're not going to know the value of the true value of the output gap. And hence, you're going to have to guess a bit, and if you guess incorrectly, you're going to get different results. Now, to open that channel more clearly, if you do optimal policy in these models, typically you want to have the neutral rate of interest as a time-varying intercept in the Taylor rule. So if you put it there, instead of having the standard Taylor rule, where you just respond to inflation and output gaps, you also have at the intercept the time-varying natural rate of interest. You should move the interest rate one for one with these changes. And it's well known that in a New Keynesian model, in the case of full information, that tends to undo the effect of most of the real shocks that you hit the model with. So you get no implications on output gaps and inflation of these shocks if the central bank just sufficiently offset them. The problem is if the central bank doesn't know those shocks, even if it would like to offset them, it can't because it doesn't know them perfectly. So they try to do their best in terms of moving the rate in correspondence with the natural rate of interest, but they fail because of imperfect information. And I think, given the discussion we had in Sweden about where the nominal interest rate had to go in order to be consistent with the forecast, which essentially reflected difference in beliefs about the time-varying neutral rate of interest, where markets might earlier than the central bank have perceived that rate to have gone down substantially. You know, to allow for that, we now put in that time-varying concept of the natural rate in the Taylor rule. And that is going to lead us to results of this type of nature. So if there's a shock to the natural rate of interest, which, for example, could be a technology shock or any other real shock, we're going to see now, in the case of full information, to actually the actual economy reacting more and the partial information economy reacting less to output. Whereas inflation, you do get a response. And clearly here, the point is that when there is a technology shock, the central bank doesn't observe it perfectly. It only sees a bit of it. It doesn't raise interest rates sufficiently, and that leads to output that leads to an inflationary response of the economy. So if they had the perfect observation, they could have done better. Sorry, it doesn't lower interest rates sufficiently much, and that induces a negative inflation response, and this negative inflation leads to output dispersion in this model, which leads to aggregate output not rising as much as under perfect information. And if you look at the extracted shocks in this natural rate of interest shock, you see that the private sector in this in this economy actually has better information. It managed to extract, the central bank, as in the previous case, extracts a better value for the technology shock, but doesn't fully see that it's technology driving this. The private sector has even worse information, so it even further understates technology. And instead, both the private sector and the central banks believe that other shocks are driving this. So even though the true shock in the economy was only technology, both the private sector and the central bank believes that it was a mix of all shocks, perfectly consistent with the Kalman filter. If you don't know the truth, you're going to think it's a mixture of everything. And the mixture depends, obviously, on the relative variance of these shocks. So if the variance of demand shocks are very high relative to technology, you're always going to believe that a pretty substantial fraction of whatever movement in output you see is going to be the demand shock and not output, and not technology. Okay. And future work, we're going to talk about releasing the central bank's forecast. And the experiments we have done so far all indicates that releasing the central bank's forecast is going to reduce the discrepancy clearly, but from a positive viewpoint, of course, it's going to make it harder to explain the data. So if the central bank reveals all of its information, we're back to the case where the private sector is perfectly informed because they have all the... No, sorry. The private sector has much better information than the central bank because not only does it have all the information of its own, it also sees exactly what the central bank is seeing. And given that, it's going to be much harder to generate a discrepancy between the beliefs of the private sector and the central bank, and hence we're going to have a much harder time explaining the actual observed data. And that is a problem in the sense that if you look at the Swedish data, clearly the central bank did publish these forecasts. So for some economies it's reasonable, like the euro area, for example, does not publish explicitly an interest rate path, so there is reasonable to argue that this is okay. But in the case of the Riksbank, we do publish that interest rate path, and hence it's a harder time claiming that we don't. Okay, I'm going to talk something about the practical experiences and implications for policy. So if you start about implications for central bank analysis of the kind of work that we're doing, or of the situation that we're trying to capture, what that tells you is that it's important to try to understand the source of the discrepancy between the central bank and the private sector. Because you might be tempted to say, suppose we have a forecast where the central bank thinks everything is equal except from the fact that the private sector thinks interest rates are going to be much lower than the central bank. Then some people will argue that's then stimulative for the economy because lower expected interest rates through the Euler equation will feed higher inflationary pressures, positive output gaps, and those kind of things. But then obviously we would counter-argue and say, look, suppose that the reason for lower interest rate expectations are a worse outlook on the economy. For example, driven by, in our case, a more negative stance on the current nowcast. Why the decomposition of the current nowcast? Suppose you believe that has some negative implication for the future. Then clearly it's not more expansionary just because agents believe that interest rates are going to be low for a long period of time, because what counts in terms of expansivity in the Euler equation is both expectations of future interest rates as well as the output gap. So it's important to take a stand on why do you see these differences compared to the private sector. And therefore I think a conclusion is use markets to cross-check. We sometimes in the analysis have a financial markets kick-off when we do our monetary policy rounds, where we look at lots of financial variables, interest rates going up and down, oil prices are moving and whatnot, and then we turn the page and go into the macro models. And essentially nothing in that financial markets outlook survives through the rest of the policy process, because once the macro model starts to go, there are no oil prices in them, no stock prices, and then everything just sort of progresses without thinking about financial markets. And I think one way to use that data more efficiently is try to get the macro finance team, if you have one, to extract the best possible macro picture that you can get from the macro data and use that as a kind of discussant on the macro outlook you have yourself, both from the models as well as in the judgmental forecast of the central bank. And the reason for that is that you would typically, at least in our case, you would typically have three sets of forecasts. One would be the ones that come from the unadjusted models. One would be the judgment-based forecast, which takes the models and then massages it for whatever expert reason. And then you also have markets. And we tend to forget about this last part. And I think it's important to cross-check all these three against each other and look for frictions. So if you see that they disagree in some important aspect of the economy, then you might need to think another round about what implication that has for the appropriate stance of policy. And just to give you one example, think about the exchange rate that, at least in the case of the Swedish economy, is very important. Sweden is a small open economy, lots of imports and exports. And suppose that we have a situation where the exchange rate has appreciated since the last policy round. But suppose that for whatever reason, models do not see any change in the course of future interest rates. This is just an example, either for the local domestic economy or for the global economy. And suppose, for the sake of it, that the Monetary Policy Department agrees, so that there's no revision in terms of the interest rate spread between Sweden and the foreign economy. But suppose that market rates actually did move during this period. Then I would argue that in this case there is a friction, because in the forecast, in the nowcast of the central bank, this appreciation must be explained through a risk premium. If you believe in some sort of UIP condition, if you see no movements in relative interest rates, but you do see a movement in exchange rate, the interpretation must be that there was a risk premium that pushed the exchange rate. And that has implications for the forecast of the future exchange rate, if you believe that these risk premium things are temporary things that quickly go back to steady state, let's say. But in reality, the movement of the exchange rate was perhaps possible to explain by the fact that market rates did move during this period. And hence there's a perfectly rational explanation on markets for why interest rate moved, fully consistent with a sort of UIP story. Might not be the best example in the world because UIP sometimes doesn't hold and so on, but just as an example. So this would be a case when there would be a friction and you would need to think hard about your exchange rate forecast in order to assess whether it's really consistent with what's going on. To have a fully consistent story, I guess, would require that you do the kind of model that we tried to play with in the beginning of this talk. But that's hard, and it's especially hard if you do a sort of realistic, large-scale macro model. Now, alternative interest rate assumptions. You could, what do central banks actually do in this case? Some central banks work or used to work with a constant rate assumption. So essentially, in the internal forecast, possibly external as well, you would assume that the interest rate would not be changed at all over the forecasting period. Then you would see what that would imply, and that would be essentially a basis for discussion of the board. But suppose we do not move interest rates, maybe inflation then will look very high, and then the board would say, oh, this we can't have. We need to raise interest rates to make sure that this doesn't happen. You could do, but that's very hard to work with, especially in modern models. It was okay with backward-looking models, because there you could just pretend that the interest rate was kept constant. But in forward-looking models, typically you get indeterminacy if you try to work with a constant repo rate in that type of framework. You could also do the market path and say, let's condition on what the market is currently thinking. But then you have the Woodford warning, essentially saying that it's dangerous if the central bank just starts to use the market's view for their own decision-making process, because that could lead to indeterminacy itself. If markets, for spurious reasons, starts to fluctuate, and the central bank just follows that and uses that in their forecast and set rates accordingly, then you may end up in a very bad equilibrium. And the third one is to use an interest rate path, where you force yourself to actually discuss what you think is going to happen with the interest rate going forward. And I think many central banks are here. Some central banks only do this internally, so they don't have an external path. Some central banks do it at the staff level, so you have a staff forecast, which may include a time-varying interest rate path. And some central banks, like the Riksbank, actually publishes the entire path. Now, the practical experiences of this. So the pros is that the internal work is much easier. So imagine when you try to do a forecast with a constant rate, no one believes that the rate will be constant, so the forecast will look very strange most of the time, unless you believe that the impact of monetary policy is negligible on macroeconomic variables. But if that's true, then who cares? Now, the second thing is that the external discussion tends to be much more fruitful. So at least in the case of the Riksbank, and I know at the case of the ECB, which doesn't publish, all the questions that Trichet had to answer were essentially, so what you're going to do next time around? Oh, we don't comment on this. Oh, what you're going to do later on? No, we can't discuss that. We only discuss the current stance. So you get a very sort of poor discussion about the decision. And it's much easier if you actually can talk about the future. No, we think we're going to do this. We don't know for sure, but this is the sort of best assessment that we have at the moment. So when you talk to people both internally as well as externally, the level of discussion typically becomes much better if you can talk about the full forecast rather than just the current point forecast for the next quarter. And of course you have the possibility to guide at least shorter term interest rate expectations. And there we have been reasonably successful in guiding the expectations, say, from this period up to 1 year and a half, something like that. We had much less success on the longer horizon. I would argue that if you believe that price rigidity is sort of declining over the longer term, it's actually most important to control this shorter term outlook rather than influencing expectations about what's going to happen in 5 years. And hence, you know, even our experiences have been bad in terms of that 3-year horizon, let's say. Actually, the first couple of years have been relatively successful, and maybe that could be a reason to say, no, let's not talk about the entire future of the interest rate path. It might be sufficient to talk about the first couple of years, let's say. And the cons is that it's really hard to make good predictions, also about the interest rate, which is very annoying from the central bank viewpoint. And of course, there's a risk that bad predictions hurt your credibility. If it only hurts your credibility about talking about future interest rates, that's okay, because the alternative is not worse. Or, you know, the alternative is worse. If you don't talk about it at all, you have no ability to control longer-term expectations, and so on. But what could happen is that not only markets stop listening, but there might be a spillover to overall credibility. And my interpretation, very personally, of how some key policymakers at the ECB argued was that this is the reason why you might not want to publish this forecast. That if they're bad, and that hurts the credibility of the central bank, it hurts the credibility in a wider sense than just in terms of discussing forecasts. It might hit overall credibility for the institution, and in particular the credibility to the inflation target itself. So in this analysis, we assume that nobody questioned the 2% inflation target, let's say, but they only question the exact nature of what you're going to do with interest rates the coming few years. If you think that this credibility will spill over to questioning the 2% inflation target, then you might end up in a situation where you say, no, we're not going to publish because we don't want to risk the sort of the nominal anchor of the economy. On net, for me personally, I still favor publishing forecasts because I really think they do help in the communication aspect. Possibly with the sort of, you know, we perhaps should have had a slightly shorter horizon in the publication of those forecasts. Focus more on the coming maximum 2 years or something like that. Because the discussion about the long term has typically not been that fruitful from our experience. So I'll stop there.
Thank you very much, and we open the session for questions and answers. Do we have? Maybe I will start with the question. At the end, you mentioned about the credibility issue for the central bank targets and for its monetary policy. But during your presentation, you almost, at least I have not heard about that. Yeah, so you talk about all this deviation of forecasts coming from the different interpretation of the shocks of the economy. But what do you think would be the consequences if, you know, the credibility of the central bank is quite poor, like in Ukrainian case compared with the Swedish case, and what should be the, you know, the consequences?
Yeah. So I think that's a really key issue that we can't handle in our model. It's something that I wanted to explore a bit in the past, in the sense that if you look in the literature now, credibility is typically is this sort of, you know, either you assume perfect discretion, so you have no credibility whatsoever, except for the target itself, but you have no possibility in influencing expectations by announcing what you're going to do, or you assume perfect credibility, which is to say that you believe that you can have any kind of influencing of expectations. It's true that there are some intermediary cases like the Taylor rule, where you have full commitment to something which is not fully optimal. And there's also a few papers that have done sort of exogenous credibility. So you say that agents think that the probability of the central bank deviating is P, let's say, but that P is exogenous, so it's not influenced by what the central bank is doing. I think a very interesting exercise, which would be relevant clearly from the case when you try to build credibility, is exactly to have a model which allows, and you know, I can see that you could do that in a sort of Kalman filter setting, where the central bank says that we're going to do this, and then tomorrow comes, and if you have a setting like we have here, the problem is that you can't know, you know, the credibility, the full credibility story is you say, we're not going to change our forecast unless something happens. But if something happens, we're allowed to change our forecast. It's not an unconditional promise that we're going to stick to this. So when the Fed said we're going to keep interest rates low for a long period of time, suppose they would have said we would have kept them low until Q3, you know, 2019. That was not an unconditional promise, because if a major shock would hit the economy on the upside, clearly they should be allowed to change interest rates. It's just that if there are no news in the economy, you're not allowed to change your reaction. But then the problem is in practice, since we don't observe the shocks, who could tell with 100% certainty? Now, did the Fed raise interest rates prematurely because there was a positive shock to the economy from the viewpoint of what they expected when they made the promise? Or did they actually renegade from their promise? So you would need sort of this model combined with that credibility, and then endogenously having the private sector figure out, you know, was this due to a shock or was it due to the... and then you could discuss, you know, under the conditions where it pays the central bank to build credibility, because you know it's going to cost something to establish it, but once you've established it, you're going to get the benefits of having expectations aligning much better to new shocks. And I think that would be really interesting to do. But it's very difficult, and you know, we had a hard time just doing this. But of course, the sort of intuitively, you would expect if you have low credibility, clearly you have low, you know, you have less possibilities of influencing future expectations. So once you take our framework and you add to that releasing forecasts, if you have full credibility, I expect that this will lead to, you know, infinite resolution, essentially, of uncertainty for the private sector. So you're going to have, both will agree, essentially, in their forecasts. Whereas you have low credibility, you're still going to have a big deviation. So one interpretation, unfortunately, then for us would be that, you know, we didn't have credibility for our interest rate paths, and hence. But there, you know, it's a difficult concept of credibility, because one interpretation of credibility is that we think the central bank is lying, or, you know, is not telling the truth. Another interpretation is we think the central bank is wrong. So it could well be, like in our model here, everyone believes in the Taylor rule. So everyone believes the central bank is trying to respond to inflationary pressures. It's just that they're going to have a different forecast for inflation. And hence, they're going to forecast that once you see inflation coming up, you are going to raise interest rates, even if you don't think so right now, because your inflation forecast happens to be low. So in a way, you can say credibility is perfect for the central bank. It's just that the credibility for the forecasts themselves are low. So in a way, you could sort of separate the conduct of policy from the forecasting ability of the central bank. And in theory, that could be done in this framework, but it's going to be difficult.
Other questions? Yes, please.
Thank you very much for your presentation. To be honest, I have many questions, but I will definitely ask only one for today. So going back to the data you showed us and to the interest rate path of the in Sweden, well, to my understanding, there is a huge dependency or a huge impact of ECB policy on the Riksbank. And probably this period of very long interest rates was also affected during this channel. Do you think this can lead to these discrepancies in expectations? Maybe agents that do expect something from abroad, or they expect not only the policy from the central bank of the country, but also the exogenous policy.
No, I think certainly that this was a key factor. So one interpretation would be that the Swedish central bank and many other central banks at the time perhaps relied a bit too much on the IMF and OECD forecasts, which were kind of upbeat, saying that no, everything is going to stabilize, it's looking good, trying to get a positive atmosphere going somehow. And then when the double dip recession essentially occurred in the euro area, we had to revise that outlook. And it's perfectly possible that sort of global markets had already discounted that pretty substantially way before the central bank started to do so. And that's essentially what you're saying, that markets had a worse macro outlook from that standpoint, and then they thought interest rates would be lower, not because they thought monetary policy should be more expansionary, but just because they saw a worse macroeconomic outlook than the central banks did. So that's certainly one major factor, I think, that contributes to the explanation.
And did you try actually to estimate this model on the Swedish data to see what discrepancies in expectations were driven by?
Yeah, we wanted to. The problem is that with this infinite state issue, it takes a long time to solve the model just once. So if you want to estimate it with maximum likelihood, it's going to take a really long time to sort of get going. But our aim is at some point to try to, we hope to be able to fine-tune the calibration a little bit so that we might even employ some Bayesian methods or something like that to sort of narrow down the likelihood function a little bit in order to avoid the typical estimation problems you have with these models when you do regular maximum likelihood estimation. But many things has to happen before we get to that stage. But it would be a useful sort of endpoint to have a better estimated model.
Thank you for your presentation. I just want to clarify one point. You said that it's better to publish short-term forecast for the interest rate, but what are the risks? Because if you have quite long forecast, you just have at the end your policy rate on the neutral level. So what is the risk? What are the risks of publishing?
That's actually it's something I forgot to say. So thanks. So one possible explanation for why we had such high interest rates in the beginning of that interest rate hike period was that there was a concern for debt growth and these kind of things. And the board wanted to sort of show the private sector that at some point, even though interest rates are low now, at some point later on they're going to be higher. And that sort of led to a tendency of wanting to have a reasonably high endpoint. And of course, in terms of forecast evaluation, that high really hurts because when you square the deviations from actual outcomes, they become huge. And probably a much better way would be to do it like the Fed and actually have like a steady state indication. So you say, if you want to communicate about what you think about the long-term interest rate, one way to do it is just to have that point that they have in their graph that says sort of, this is the path we believe in, and here's a point that sort of signifies the end or the neutral rate, if you will. And I think maybe that thing would be would be better in the sense that then you could communicate both, but you wouldn't have to focus too much about that period 2 to 3 years, which is extremely hard to predict in the short run, and you would get away from a bit of that discussion that we have had surrounding those forecast errors and so on. So, I mean, it's not super good arguments for why you shouldn't, but in a way, I guess, from a pragmatic viewpoint, it just tells you that from experience, it's reasonably possible to do forecasts of the sort of 1 to 1.5 year horizon, whereas the outside 2 years is just very, very hard. And then there's a risk that volatility will spill over into a discussion about your forecasting ability and things like that. And I think the value of those long-term forecasts is lower than of the shorter term, in the sense that, you know, if you believe that prices are rigid but not that rigid, it seems reasonable that if you can make reasonable announcements about the near term, that's going to be much more important than if you can talk about the longer term. And I think actually there's a paper, one of the few exceptions of this extreme assumption about commitment and discretion, that shows that if you have partial commitment and if the expected commitment is expected to last for like 3 quarters or 4 quarters, then you essentially get most of the benefits associated with commitment already then. And that's, to me, is a sort of signal that, you know, you don't need to go that far out in order to reap most of the benefits that you get from communicating about the future.
Are there any questions? Okay, in that case, thank you very much for a very interesting presentation, and you know, always welcome an additional Net Coffee break, and we will be able to receive new research. Thank you.
Thanks a lot.